Last night we had a speaker dinner, and it was a really nice dinner. It was a very long table that we all sat at, and given the way the markets have been performing, it kind of had a reminiscence of the Last Supper. So let's hope that that doesn't come around. What I want to talk, before I jump into my speech, I will be back on this podium a little after noon on the round table with Charles Payne. And at 1 o'clock, I will be doing a breakout session on the bond market, my passion, in Delaney 1. So I mentioned it up front because I always forget to mention it at the end. I want to talk about realignment in 4, 5, 6. What's happening in the markets or what's happening with policy and the way it's affecting markets, way more than just tariffs. This is a realignment that the Trump administration is trying to do that only comes around a couple of times a century. We called it, the Versailles Treaty, Bretton Woods, the Plaza Accord, those types of things. It's what they're attempting to do is on that kind of scale. And I'll go through what it is that they're doing and why they're doing it. And I think the result is going to be what I call the 4, 5, and 6 markets, that over the next decade or so, cash is going to give you a 4% return, bonds are going to give you a 5% return, and stocks over the next decade are going to give you a 6% return. Now, within that, there's going to be plenty of opportunities to do better. There's also going to be opportunities to do worse. So that's where I want to go with this presentation. I'll start off with this chart here. This is debt to GDP. Debt to GDP peaked. That peak in the middle was World War II. We've come back up to the near the peak. And the red line is the Congressional Budget Office's estimate of where we're going to go over the next 10 years, and we're going to go to a new high. The comment on the left, on the top, was from December from Jay Powell, the Federal Reserve Chairman. He said that this is unsustainable and that things have to change. And so you have to ask yourself a question. Was the U.S. coming into this situation in the middle of an unsustainable crisis? Jay Powell said yes, and I agree with him. And another person agreed with that too, and that's Scott Bessent, the Treasury Secretary. Last year he spoke at the Manhattan Institute, and he said that we are in one of these moments geographically where we are going to see some kind of a major realignment of the global trading system, and he wanted to be part of it. Now, a couple of things about that. Why now? Why did we get to this point now? So, the economic historian Neil Ferguson wrote an essay in the Wall Street Journal about a month ago, and he talked about what was called the Ferguson Ratio. It was not named after him. It was named after Adam Ferguson, the 17th century economist, who said that when a great power spends more on interest costs than it does on defense, it ceases to be a great power. The blue line on the chart is interest expense. The red line on the chart is, or orange on the line on the chart is defense, and we crossed over in October of 2022. Now, Neil Ferguson went on to say that this is something that we've seen for hundreds of years with empires, that when they start to borrow too much money, that they get into trouble. But there have been cases where an empire that borrows too much money can pull back out of that quickly. And that's what the hope is going to be, that we can wind up hopefully pulling back out of it quickly. So I'll ask the question again, are we in a crisis? And is it time for change? And the answer is yes. And that gets us to the tariffs. So this is the average tariff rate that we've seen in the economy over the last, or the US economy over the last century. And that red line is what Trump proposed on Wednesday. So we're going to see the highest tariff rates that we've seen in a year, 100 years, excuse me. Now, why is it that we're doing this? Well, first of all, if we are in a crisis, we can't go back to the status quo. So one of my criticisms has been for people that yell and scream that Trump is doing this wrong and that Trump is going to destroy the world. Okay. What's your plan? If you think this is the wrong plan, what's your plan? And if your plan is, let's go back to $7 trillion budgets, $2 trillion deficits. Let's go back to $40 to $45 trillion debt. That's not the plan. That's not going to work anymore. So if you don't like that plan, give me another plan. But they don't have another plan. They just want to yell, Trump's got the wrong idea. And look, I'm open to the idea that he might be wrong on this. But what I am pushing back on is, so what do we do if he is wrong? We just don't go back to just the old system and then give out the old saws, tax the rich. There's not enough money among the rich anymore to do this situation. So what Trump wants to do is he wants to bring back manufacturing jobs. He wants to bring back heavy industry jobs in the United States. Now, why does he want to do that? The blue-collar jobs. Let me give you some uncomfortable statistics. 65% of the American population does not graduate, does not get a college degree. They only get a high school degree or less. 35% of the American population has a college degree. The 65% that does not have a college degree have an average life expectancy of 7 years less than those that have a college degree. Why is that? They breathe the same air, they drink the same water, they have the opportunity to eat the same food. So why do they live 7 years less? So the Princeton economists Ann Case and Atticus Deaton did a landmark study on this about 10 years ago, and they called it deaths of despair. What's driving their life expectancy down is liver disease, alcoholism, drug overdose, suicide, because their jobs have been shipped overseas. Their towns have been boarded up. Their opportunities have gone away. I'll be honest with you, I heard Rick Cannell yesterday. I'm open to the idea that this might work. I'm also open to the idea that this might not work. But what Trump is doing that's different than anybody else is he's going to try to address this. He is not going to condescend them like the previous president when he said, just learn the code or go back to college. He's not going to tell them that there is no hope like the president before that when he said, what are you going to do, wave a wand to bring those jobs back? Maybe Trump doesn't succeed at it, but at least he's going to try. And that's what we've got going on. So this is a much bigger issue than just tariffs, because it's about trying to bring down the debt by bringing back more jobs to the United States, by bringing back more income to the United States. Now, outside of the purview of my presentation, there's a whole nother aspect of what they're trying to do, and that's payment for security. And what they're also pushing very hard on is they want Europe and NATO to pay trillions of dollars to build up their own militaries, so we don't have to spend the money to be the cop of the world, so to relieve us from that burden, to help us bring down those costs as well, too. But let me talk about tariffs, and let me talk about where we are with tariffs. Here's the chart of the largest trading partners in the United States. The biggest one is Mexico. The next biggest one is China, and the third biggest one is Canada, and China and Canada are about the same, and then it drops off a lot to Germany and all the way on down. The vast majority of our trade comes from China, comes from Canada, and comes from Mexico, Mexico being number one. Why is Mexico number one? Because Mexico has effectively become a tariff arbitrage. We tariff China. China's an adversary. We're worried about China. How does China get around the tariffs? They ship parts down to Mexico. They pay Mexicans to assemble them, whether it's a car or a computer, and then because of USMCA, they ship them up to the United States without a tariff. So they're trying to go around the tariffs by going through Mexico. Mexico's more than happy to do that because Mexico wants all of those jobs. So this is part of the global realignment we're going to do. That plus payment for security and tax cuts and deregulation to try and realign not only our economy, but realign our economy relative to both our partners and our adversaries under the assumption we have no choice at this point. The status quo cannot stay. We have to try and do something else. Now, Trump's been coming under tremendous criticism for this. And people have been talking that he's got wrong policies, ham-handed policies. Well, there's this guy named Warren Buffett, lives in Omaha, might have heard of him. He wrote this piece in 2003 in Fortune magazine. America's growing trade deficit is selling the nation out from under us. Here's a way to fix the problem, and here's what we need to do now. You could have basically put Donald Trump's name on this piece, and it would have been, and it would have sounded pretty much like he's been saying this. Now, I know Buffett has come out and done a complete 180 on what he wrote 20 years ago about the trade deficit. That might be more politically oriented than it might be that he's had a rethink about economics. But what is the end game here? A lot of people like me and everybody else think the end game is a deal. Trump is talking about a deal. But where I think that the media gets it wrong is that they think that the rest of the world is stationary. And this is all about whether or not Trump can have the fortitude to stay and whether or not the stock market decline is going to push Trump to relent. But what we're forgetting is that the rest of the world has a lot of say in this too. So Bloomberg does a study, or does a survey, excuse me, of economists asking them, what is your 2025 GDP forecast? So this is always constantly updated. This is, what do you think the economy is going to grow this year? The black line is the US. The orange line is Canada, and the green line is Mexico. Back last summer, all three countries were expected to grow about the same rate. But you could see how Mexico in the green line economists have really been turning sour on Mexico because of the pressure that the tariffs are putting on them, and more sour on Canada than we've seen from the US. Let me dig into Canada further. Yesterday, the US released its payroll report, but so did Canada at the same time. They released theirs. They lost 32,000 jobs in the month of March. That is the most number of jobs that they've lost since 2022. Canada and Mexico are under even more pressure than the US to come to a deal. They're our two biggest trading partners. Europe is under more pressure. So Trump, I think, I'm doing what everybody says you can't do. I'm going to get in the mind of Trump, and that is he's going to hold the line, betting that they're going to have to come to the table before he has to relent. And because, again, we have no choice, we have to try and change things around. So where's this put us with the markets? And that's where I get to the 4, 5, 6, and I want to start with inflation. This is a chart of core personal consumption expenditures. This is ex-food and energy. This is the other measure other than CPI that the Federal Reserve thinks is a better measure of inflation. It is a measure of inflation. I color-coded it. So in red was before COVID, and in blue is the inflation rate after COVID. And the shaded area on the chart just shows you basically what has been its recent range. 2/3 of the measures fall within the shaded area, and the horizontal line is the average for those periods. You can see that inflation post-COVID, the blue part, is nothing like inflation pre-COVID, the red part. We're in a different inflationary environment. We are in a higher inflationary environment. We've got the blue line right there. I put some labels on it to show that the inflation rate is stalling out at a much higher level than what it was pre-COVID. So the first thing I'll point out to you is that inflation is a very different animal now than it was in 2019 or earlier than that. We are in a higher inflation world. Now let me be clear about this. We are in a 3-ish% inflation world, not an 8, 10, or Zimbabwe inflation world. So when I say we got inflation, I want to make sure that we understand that that's where I think it is. So what's the difference between 2 and 3? Well, if you're on a fixed income and you don't own any assets, it's a huge difference for you, but it's a big difference when it comes to interest rates. And that's what I'll talk about in the breakout session. This chart here comes from the markets. There is a Treasury inflation protected securities market. So he pays you an interest rate plus the inflation rate. And from that market, you can back into what does the market expect the inflation rate to be over the next 2 years. That orange line has been going straight up since last September. The expectations are for high inflation and ever higher inflation. Now, lately, people have said the reason it's rising is because we're going to get higher prices through tariffs, and that's true. But this was rising well before that. This started to rise in September when Harris was leading in the polls. And we weren't really talking a lot about whether or not we were going to get tariffs. So the inflation expectations that are built into the market have been there for a long time, and they continue to build. So I would argue that when you look at the markets, the first thing we have to do is we have to look at inflation. And that brings me to this chart. I updated this chart through yesterday. So this is the 10-year yield. So where are we tonight? After the Last Supper dinner, we're talking about the idea that maybe we saw a market crash over the last 2 days. You define it, 10% down in 2 days. Maybe that is a market crash or not, but it's 10% down in 2 days, and that doesn't happen very often. JP Morgan has got a 60% chance that the economy might go into recession. We have got unprecedented levels of uncertainty, if you watch financial television, and we've got an unknown policy that we've seen with tariffs. That should be a cocktail for plunging interest rates. This is the 10-year yield. In September, the 10-year yield was at 360. It rallied all the way, or rose all the way up to 475 in January. It closed yesterday at 4%. Given everything I just said, plunging markets, recession, uncertainty, policy we've never seen, this blue line should be way below where we were in September. But it's not. Why not? Because of inflation. The concern of inflation, or if you want to call it stagflation, because stagflation is both slow growth and high inflation, so it's in the stagflation measure as well too. It's not. So you could see that there is a metric in there about inflation. Where does that bring us to the market? This is a chart that shows the market's probability that the Fed will cut rates at its May 7th meeting, its next meeting. The dotted line is 50%. And if we get below, and this is because it's a cut, it's minus. So if you get below the dotted line, it means the market starts pricing in a cut. It's not. It's not pricing in a cut yet. Why not? We're talking about recession. We're talking about market crashes. We're talking about unprecedented things happening. Why aren't we talking about the Fed cutting rates? Because of inflation. And that's what Jay Powell said in his speech yesterday. They can wait because they're very worried about inflation. So that's the overriding concern on top of everything else. It's holding us back from getting those much lower interest rates. So what I would argue to you first, let me go back to this chart, is the 4 in my 4, 5, 6 forecast. The funds rate is at 4.25 to 4.5. That's the range it's at now. I don't think it goes much lower than that, if at all, which means that Treasury bills, money market funds are going to yield you something like 4% moving forward. Bonds. This is a chart of the yield of the Bloomberg U.S. Aggregate Index. What is that? This is all treasuries, all corporates, all mortgage-backed securities, all agency securities, all investment-grade bonds. This is $30 trillion worth of bonds. What is its average yield? Well, the gray line on the chart there shows that for the last 2.5 years, the average yield has been 4.86. Let's round that to 5. I think that over the next several years, you're going to get the coupon out of bonds, and you could maybe in some years, because the yield has been falling, you'll get a capital gain because when yields go down, prices are going up. Other years, you might see yields go up, and then you'll see a capital loss. That was last year. But over the average, I think they're going to average 5%. So that's the 5 and 4, 5. Why? And this is where the inflation number comes in. What's the difference between 2 and 3? 5% interest rates. Maybe even higher interest rates, 6% interest rates might be possible. So we have to look for that. What about stocks? This is the Shiller CAPE ratio, the cyclically adjusted PE ratio. Bob Shiller, Yale University, won the Nobel Prize in 2013 on this metric, and it's at 37 right now. He's got this metric done, he's recalculated it back to 1880. The stock market is extremely high in its valuation. Only 2 other times in American history has it been higher than this. And they both happen to be in our lifetimes, 2021 and 1999. We're even higher now than we were in 1929. So what does that mean for the stock market? Well, people famously say stocks, valuation's not a timing tool. It's never been a timing tool. It's an expectations tool. So here's a couple of messy charts here. They show you a scatter graph. So on the x-axis is the Shiller PE ratio, and I put a vertical line at 37. And the orange dots show what did the stock market return over the next year. That's a shotgun blast. Valuation doesn't tell you a whole lot about what's going to happen in the next year. The blue dots show you what is the market's return in the next 10 years. There's a little bit more of a relationship there. And it says, now bottom line it for you, stocks will return you something like 1% more than the bond market, maybe 2. That's the 6. That's 4, 5, and 6 because of the high valuations throwing in the uncertainty that we have to start to change things. Now, what does that mean for stocks returning you 6? I got a lot of clients that are professional managers. And in 2023, the stock market was up 22%. In 2024, it was up 25%. And they would go to their clients and they'd say, have you looked at value? Have you looked at value stocks versus growth? How about Europe versus US? How about financials? How about healthcare? How about energy? And the response that they would get is, and I'll use some of the technical language, who gives a shit? Because the stock market's going up 25% a year, buy an ETF of the S&P 500 and just go with the flow. And I use the analogy that it's like sailing. I don't know anything about sailing, but if you put me in a sailing boat and there's a 25 knot wind at my back, 25%, all I got to do is get my sail in the air and I'm going to move forward. Well, if we're going to slow down to 6%, well, now that I'm in that boat and I got a 6 knot wind, I better learn to tack and trim, otherwise I'm not moving forward. So now, what does that mean? Well, the index might go up 6%, but there will be opportunities within themes, stocks, sectors that you could do better than that. And now you don't have to think about, well, somebody says value stocks are a good idea and they went up 16% last year, and you say, what, who cares? They went up 25 otherwise. So that's the 6 and the 6% number. That's what I think we're doing, is we're doing a realignment in this economy, and and the results is going to be these low returns, but there's going to be opportunities if we reorient the way we do things right now. Lastly, I'll tell you that we manage a fixed income ETF. It's for total return. It's called the Wisdom Tree Bianco Fund. WTBN is its ticker symbol. And at 1 o'clock in Delaney 1, I'll tell you more about it, and I'll tell you more about the bond market, which of all of the asset classes is the best performing asset class this year, and why that might be, and how is the best way to invest in bonds. So with that, do I have time for questions? One question. Better be a good one.
I missed the first part of the presentation, so hopefully I hadn't already answered the question. But when you're talking about performance going forward, are you just mainly focused on kind of the lagging sectors over the past 2 years? So when you're saying, for example, small caps or value, or what is it you're focused on now and looking at opportunities that might be above that 6% that you threw out as far as returns going forward?
Yeah, so the question is, what sectors, what should we be looking at? I would say that in this type of environment, when you're like, mid-single digit return, the sectors are going to rotate all the time right now. So whatever sectors you have now might not be the same sectors that you had in 2 years. It's not a monolithic market now. Just buy the market. Just buy the market, buy SPY, watch it go up. And that's not the environment we're in. I'm a bond guy. And so I want to talk more about the bond market at my breakout, but I will say this, is that now is the time that you can look at the sectors, because what I talked about before was, anybody came to you from last year to the year before, from 2010 to 2020, and talked about sectors, the argument was always, why waste my time with that when I could just buy the index and watch it go up? Well, the index might not necessarily be the way to go anymore. We have to adjust our way of investing. If you want an example of this is the 70s. Throughout the 70s, the stock market was returned 5%. And I'm talking about 6. Does that mean that the 70s were a bad time to invest? Well, no, because if you caught energy at the right time, if you caught industrials at the right time, if you caught the sectors, there was 200% and 300% gains that you could get in the market. What I am advocating is, this is a different environment now. The environment is not what big broad ETFs do I buy and just magically watch them go up. It takes a little bit more work. But that's what you're hearing from here, and maybe active management could be a way to talk about it. And bonds will become a competitive investment in that environment, which I'll talk about in my breakout. Thank you.